Hey guys, it's Marco Glisick with GreenGrowth CPAs, partner at GreenGrowth CPAs. Welcome. Super excited to have you guys today. This is what I like to call, a offense tax strategy, where now as opposed to kind of, being passive and whatnot, kind of more, doing the tax returns and more kind of mitigating the risk. We're actually going on offense and we're kind of taking active steps to minimize and really save taxes starting today. Let's get started. I'll see you guys on the other side.
Hey everybody, I want to welcome you for another exciting webinar. My name is Marco Glisick and I'm a partner with GreenGrowth CPAs. In today's webinar, we're going to cover cost segregation. It is a very exciting topic, and the reason I'm so passionate and excited about it is that it has proven to be an amazing tool when it comes to tax savings and cutting down your tax bill. And it's an offensive tax tool, right? The way I like to think about tax, right, is in a lot of ways as a sports game, right? You kind of have the defensive aspects and then you have offense aspects of the game, right? So, kind of think about your tax compliance, filing the forms on time, filing the right forms, filing the forms properly. All of those are defensive aspects of your tax situation, and they're very important, and doing them correctly really minimizes your tax exposure, a lot of cases your tax liability. But what I can see often being overlooked are the offense aspects of your tax situation. And that's where really the cost segregation has proven to be an amazing tool. It has stood the test of time and it has stood the test of courts. It's been one of the tools that's been challenged by IRS in many tax courts, over decades. And every single time, if it was done the right way and done properly, cost segregation has, stood that test. So it's a proven tool that I've seen a lot of business owners overlook. And so I'm really excited and passionate about it to share with you today. Before we dive into the materials, a little bit about us. GreenGrowth CPAs, we started off as a tax shop. We prepared over 1,000 annual tax returns for cannabis operators across all verticals. Think dispensary, distribution, cultivation, manufacturing, delivery, and testing. We have served over 350 cannabis clients. We're spread across 11 states. So think about any state where there's legal cannabis, we're probably there in the market working with different businesses. And more recently, we've started getting into a test work and more traditional finance work. So we're prepared over 12 plus audit related due diligence, M&A valuation projects in 2018. We are a young firm, but a proud one. We are a true boutique firm. We bring seasoned professionals from Big Four, so think about Deloitte, Pricewaterhouse, KPMG, and Ernst & Young, really kind of the giants of the accounting industry. That's really for us as founders. And really all our tax professionals, that's our background. That's really where we kind of source our talent, bring seasoned professionals, we infuse them with the right cannabis knowledge, and we're able to really field a seasoned team and give you that true boutique experience and showcase our thorough and deep understanding of tax, compliance, insurance-related work specifically for cannabis industry. I'll repeat it again. All we do is just cannabis and all our clients are cannabis. Before we dive into materials, I also want to just quickly cover a little disclaimer. So the information contained in this webinar presentation is meant for guidance purposes only and not as a professional legal or tax advice. Further, it does not give personalized legal, tax, investment, or any business advice in general. The agenda for today's webinar, so we're going to cover what is cost segregation, how does the cost segregation work, what qualifies for short duration appreciation, what type of buildings qualify. Then really what are the implications? What does cost segregation mean for you and your business and your tax bill more importantly? And lastly, how to perform a cost segregation study. So let's start off with cost segregation. What is cost segregation? The standard definition is that essentially it's a process of identifying personal property assets that are grouped with real estate property assets and then reallocating those personal property assets for federal tax reporting purposes. Now, there's a lot there. It's very convoluted, but essentially what it means is that by applying cost segregation properly, you can really minimize your tax bill in the current year. So let's kind of break that apart a little bit more. How does that work? So essentially, when you're looking at your property, you can kind of view it two ways. One is it's as a real estate property or a personal tangible property. With real estate personal property, you depreciate it over 20 plus years. So the chances of if you have some sort of a building, leasehold improvements, it's going to be anywhere from 15, 20 to over 30 years. So really the only way for you as a business owner, for this asset that you've paid hundreds of thousands or millions of dollars, you've invested in the business, you've invested in the US economy, the only way you'd be able to take advantage of that if you're depreciating under the real estate property rules is going to be if you stay in that building for 15, 20, 30 years. And chances are you probably won't, right? Or you just don't know, right? Chances are you might stay in that business for 3 years, 5 years, 10 years, or who knows, maybe you'll do it for 20 or 30 years. But there's a lot of uncertainty associated with that. And a wise thing to do from tax planning perspective is really to try to extract and maximize those deductions and depreciation sooner rather than later. And that's really where cost segregation comes in. It really helps you unlock that depreciation. And so the way you go about it is you go through the costs that are right now associated with that building or a leasehold. Think about different types of items, mechanical, electrical, or whatnot, are right now in that building and they're being treated as real estate. Effectively, what you're doing them, you will reclass them from the real estate property to personal tangible property. And now with personal tangible property, you're following a different depreciation rules. So now the personal tangible property, you can depreciate a lot quicker. And two, you can take advantage of the new bonus depreciation that's been enhanced with the Trump's new tax law. So now instead of waiting for these benefits, tax deductions for 20, 30 years, you're now unlocking them immediately. So for this reason, it's proven to be an amazing tool when it comes to tax planning and lowering your bill right away. Let's kind of cover a couple items that do qualify for this short duration depreciation, right? They do qualify as personal tangible property. So as we kind of think about cannabis operation, it'd be things like task-specific lighting, think dedicated electrical, mechanical, plumbing systems, specialty mechanical systems used for climate control, right? So a lot of grows are going to have these removable floor coverings, hydroponic systems, security systems, various land improvements. So as you kind of think about your operation, your build out, big chunk of that build out that costs you, hundred thousands or millions of dollars, a lot of it will actually kind of qualify for this short duration depreciation. So this is your situation. This can be a great tool for you. Let's kind of cover what type of buildings qualify. And so it's really going to be any commercially owned property or rental or leasehold that's currently in service. It could be a leasehold that you've done a lot of updates and improvements. It can be an acquired building. So you literally just kind of went out there, you purchased a building, or it could be even internally constructed building. Let's say you have a piece of land and you're kind of building your operation on there. That internally constructed structure and building would qualify for it. So really, as long as it's service and you have ownership of it, you'd be able to qualify for it, whether it's a rental, leasehold, or you straight up purchased it or constructed it. So, we've covered a lot here, a lot of these various tax concepts, but the question is really, what does this mean for you and your business? And this is the exciting part. What we've seen over and over is that potentially you can write off anywhere from 18 to 30% of your facility expenses, which is just tremendous. And roughly what we've seen is anywhere from 180,000 to 300,000 additional depreciation per $1 million spent minus the land. So this can be a big mover and shaker that can have a huge impact in reducing the tax obligation for current year. Now, how do we perform a cost segregation study? It's a very involved work which consists of working with a CPA and forensic engineering team. And the good news is that we do have a seasoned team consisting of ex-Big Four professionals who have the necessary skill set and background and have gone through various tax court cases and audits and have stood the test of time and stood the test of court cases. Things we'll ask from you is the following information, things like address, in-service date, the purchase price less the land value, improvements put to date. A lot of this can be found on your fixed asset schedule, fixed asset register, types of buildings, federal marginal tax rate, if it's subject to AMT, square footage of the asset, kind of those detailed fixed asset registers and schedules, how the property was acquired, was it inheritance, was it purchase, was it Section 1031, new construction. Once we have this information, we'd be able to provide you with an estimate and really showcase to you the ROI on this type of project. How much would be able to accelerate your depreciation and what would that mean for your tax bill? Once that's in place and we see the value in it, we have a team of CPAs and forensic engineers who can get deployed, work through the property, take the pictures, analyze the property, and really provide all the necessary documentation that IRS will need. From there, we deliver you with a couple of different things. One is the report that fully supports the positions. And again, these reports have stood the test of time and the tax courts. Secondly, we provide you with an actual fixed asset schedule that shows the new depreciation. So whether, we're doing your taxes or you have a different tax preparer, now they have a fixed asset register they can run with and they can just plug in the tax return. And then lastly, in case you've been, missing out on this deduction for years, and we've seen this in a lot of cases, I'd say majority of business owners I do talk to have not considered it. A lot of tax professionals I've talked to are not aware of it. So if you have gone for years, missing this deduction, the good news is that we can file a form for you, which is going to go back and recapture the depreciation. So you can get the benefit of it in this year. And the good news is that we don't have to amend your return. All we're doing is we're effectively filing a very simple form that allows you to recapture that depreciation. And before we conclude, a couple of key takeaways. Cost segregation can be a great way for a cannabis business to claim those additional tax deductions without violating 280E. The main concept here is that we'll be depreciating some of your assets on a shorter duration timeline, and that's fully supported by our engineering work. And lastly, it's important to really work with a firm that has experience with this and it has seasoned professionals with the right experience when it comes both on the tax CPA side, but then also on forensic construction engineering side to perform that study that can stand the test of time and the test of tax court cases. If you're interested in cost segregation, if you are in a position where you have incurred significant build-out costs, you're sitting on property or significant leasehold improvements, this can be really a great way for you to maximize your deductions, reduce your tax bill. Please reach out to us. You can get in touch with us on our website, greengrowthcpas.com, or call us at 1-800-674-9050. One thing I'll mention here that's very important: do not wait until January 1st to April 15 to do this. And the reason why is that you don't want to do this the last minute. This is something that we can do right now. Again, it's an offense aspect of your tax situation. And let's really unlock those deductions right away. Let's recapture the ones from previous years and unlock the future ones so we can start minimizing your tax bill today. Again, if you want to get in touch with us, call us directly at 1-800-674-9050.